Some interesting data to throw at you in Wall Street Confidential. Welcome back. Welcome to the new year. Welcome, Jim Cramer. Jim, I'm holding in my hand data from the St. Louis Fed showing that commercial loans and leases in 2007 reached $6.7 trillion. Astounding.
I think that people, when they're trying to struggle with the notion of what the Federal Reserve has to go through here, they tend to focus on the CPI, and they focus on the idea that there's still strong employment. I think the Federal Reserve Bank of St. Louis, which has the best by far, this website mentioned in my piece in realmoney.com, the best data by far. What's most chilling, I think, to the Fed is that there's been no slowdown in construction loans, no slowdown whatsoever in consumer debt, which is credit card debt. And what worries me is that they look at this data. It's funny because it's from William Poole, who's been probably the most retrograde Hoover-like Fed guy. This is data which says, let's take pause. When you take this data and you overlay it on this Treasury auction bit that they're doing to try to reduce the bad loans, you can see exactly what the Fed's plan is, which is to say, look, we have this one problem in the economy, which is the bad loans in the banks, but they can be overshadowed by all the other loans they're making. So let's just cordon things off, get rid of the bad loans, and everything will be fine. I think this is a naive approach. I think that the real issues here are that there are going to be fewer and fewer banks that want to lend, and they want much more of a down payment. Nat City today, when they cut their dividend, made a real strong point about how they're cutting back lending. You're going to see a precipitous decline in that data that I see from the Fed, and they are going to be so far behind the curve when that data occurs that I think we'll all wonder and say, geez, they really had an opportunity to avoid a recession here, and they didn't take it.
Now, for investors out there, the takeaway also from this data is that you're worried about certain stocks. And you talked about real estate, commercial real estate companies, credit card companies, Capital One.
Right. Now, these stocks are down a great deal. So the temptation is to say, well, look, because they're down a lot, you have to believe there's a lot of value. I also hear a lot of chatter that on a price-to-earnings multiple, they're very cheap. That's simply untrue. You have to back out the other real estate owned column. Now, those who are going to be investing in financials are going to have to get back to the idea of looking through the 10Q and seeing all the reserves and seeing what's held for investment. Held for investment is a code word for we can't even sell it. If you're looking at the banks on a multiple basis and you're not including the prospective write-downs, then what happens is they look cheap. But if you look at what's held for sale, and the way I would look at this is go look at CIT, which has a lot of different categories of held for sale and held for investment. What you would recognize is that these stocks have very high multiples. Only Goldman Sachs has, I believe, a low multiple. And that's because Goldman Sachs doesn't have a lot of things that are being held for sale.
Held for sale, held for investment.
Held for investment is code for we're stuck with it. And it will have to be written down when the bank examiners come in.
Good lesson. Thanks a lot, Jim Cramer. This is Wall Street Confidential. Stay tuned.